Well, good afternoon, everybody, and welcome to the Wednesday lunchtime drive-through today, Wednesday, June the 21st. We are almost halfway through 2023. And since the very early part of 2023, we have been sharing with our clients, as well as with those of you who are not yet members of the ChappelWood family, that we believe that the odds of a recession later this year have gone up considerably. And so that's what we have been preparing for. And we have been de-risking portfolios for many of our clients. And de-risking comes in different shapes and sizes. There are many different ways to de-risk a portfolio. I'll share a few of those later on. So, we've been talking about the very, very real probability, the high probability that a recession happens later this year. However, that got me to thinking, well, what about the other side? What if we're wrong? Which I will say, I hope we are wrong. I hope we are wrong. All right. It's a lot like the weather forecast, right? 70% chance of thunderstorms today, but that also means a 30% chance that there won't be, right? So there are many forces at play right now that would strongly indicate that a recession is on the way, but there are some other little glimmers of hope to indicate that maybe that won't happen. So I wanted to share the other side in all fairness. I mean, we don't know. Nobody knows. All we can do is look at the available information and make educated projections and then try to take action based on those projections. But nothing is ever guaranteed 100%. If you have any questions today, if you've got any comments, please use the Q&A or chat functions down in your toolbar. Should be at the bottom of your screen. Happy to entertain any questions or comments you have. So, as I just said, most signs still point to a recession coming later in 2023. Inflation has been coming down, but it's still higher than normal. It's sitting right around just over 4%. Federal Reserve wants it at 2%. Now, whether or not there's a huge difference in 4% versus 2%, which there is. The point isn't necessarily that 4% or 2% is good or bad. Obviously, 2% inflation is better than 4%. The issue isn't is 4% good or is 2% good. We'd much rather have lower inflation. But believe it or not, there is a point at which inflation is too low. Now, there's a sweet spot for inflation. If inflation is too low, like it was for many, many years in the aftermath of the 2008 financial crisis, well, low inflation is a signal that wages are not climbing very, very high and economic growth gets stunted. There's a certain amount of price inflation that we need to see that is an indication that people are earning more and that the economy is expanding. That sweet spot is typically between 2 and 3%. The Fed wants to get it down to 2%. So they continue to push to get to that level. And we've got another 2% to go. When we build out our income plans for our clients, we are using an inflation rate of 3 to 3.5%. That is the long-term historical average for inflation over a 30 to 50-year period of time, which certainly encompasses the length of time for most people's retirement. So that's why we use that number. So inflation remains higher than normal, and more importantly, it remains higher than what the Federal Reserve wants it to be. And as a result, they have been aggressively raising interest rates. And while they did not raise rates in June, so I was sharing with clients in our strategy meetings in May that there's a really good possibility that we will see interest rates go up in June or July. It was either going to be a raise in June and then a pause in July, or a pause in June and then raise in July. So we got the pause in June and then possibly raising again in July. Look, if the Fed wants inflation at 2% and we're at 4%, you do the math, right? There's still work to be done. So this belief that the interest rate increases have stopped, I don't see how that's a possibility. Not yet. But I don't expect very many more interest rate increases. And I sure as heck don't expect interest rates to go down. Not this year. It's more likely next year we're going to see interest rates start to go down. Corporate earnings are beginning to decline and layoffs have begun. Certainly in larger companies, we've seen layoffs begin. And we have seen since the fourth quarter of last year to now. And so it will be very interesting to see how second quarter earnings, second quarter ends here in another 10 days or so. It will be very interesting to see what second quarter earnings for corporations that we're invested in look like. We won't get those numbers until late July. But we have seen overall corporate earnings come down. Well, a big part of that is because costs have gone up. Inflation stays high. Not only is it more expensive for you and me to go out to the stores and buy things, it's more expensive for manufacturers and companies to buy the materials they need to sell us the products and services that they do. So their margins have shrunk, meaning their profits have shrunk. The only reason to buy and hold on to a stock is because of your belief that that company will have profit, be able to grow, and support the growth of its stock. If a company isn't earning, if its profits begin to fall, it may still be a good company, but you are unwilling to pay a higher price for their stock for lower profits and earnings, right? That's why the stock market comes down. And as earnings come down, their stock price must also come down to keep that equilibrium. If we have low earnings but high stock prices still, that's a bubble. And we would much rather have the market gradually decline than to have the bubble burst and have a precipitous fall all at once. The housing market is slowing, all right? We've got some real estate professionals. Doug is on the call today, and he's one of my local real estate pros. I'd be interested to know, Doug, what you are seeing with the housing market. But we're certainly seeing new home builds slow down. A lot of people who signed their building contracts last year, like me, who got in before the interest rates really went up, those got built. But now people starting new home builds, and they're locking in not just their mortgages, but even construction loans at 6.5%, 7% or whatever, maybe 5.5% to 6%. We are starting to see the housing market slow. The bottom line is the reason that the probability of recession is still quite high is because of all these things. And when the economy struggles with high inflation and then interest rates have to go up to quell it, recession is almost always the result. None of these things have abated. They are all still there. That is why we still believe that the probability for recession is still around 70%. However, where is it? You look at the market right now, the market's up 12, 14% on the year. Where's the recession? Where's the recession, Damon? Well, recessions take time. They don't happen immediately. The market reacts immediately, but the economy takes time. The market moves very quickly. It's because we are the market and we move it quickly. The economy takes time. Looks like we've got a comment here. Doug did give us a comment here on real estate. He says, it seems like people went through sticker shock for several months with the interest rates, but that shock seems to be wearing off. Many are accepting the new reality and starting to buy again. Okay, that's very interesting. So that's human nature, right? We go through all the phases of grief, right? And now we're into acceptance. We're finally at the end. We're into acceptance with the rates. I mean, people still are going to live in houses, right? People still want to buy. And here's the other thing. And we were joking with our intern, Asher. He's a young guy. He's still in college. For investors like Asher, who were, in their teen years when the last economic expansion after the financial crisis began, for a 10-year period, they knew nothing but 0 to 1% interest rates. You could buy money very cheaply. Now they are seeing for what for them are unprecedentedly high interest rates. For those of you of a certain age, you kind of laugh at that. You're like, 6.5%? Yeah, come back and tell me when it's 18%. That's what I paid for my mortgage in 1985. Okay, so it's all relative, right? It's all relative to what you're used to. But the reality is that we got addicted to low interest rates. That shock set in initially, but according to Doug, who is a realtor and he's out there showing homes and he's talking to future home buyers, it sounds like people have just come to terms with it and they're still buying. because they're still historically low rates, even though they are higher than what they were. So thanks so much, Doug, for that insight. Recessions do take time. They happen gradually, and it's probable that we still will have one this year. However, if there's a probability that we will have a recession, and that probability is not 100%, then that must mean that there's a probability that we won't have a recession. And I would say it's a not insignificant probability. If it's a 70% probability that we will have one, that's a 30% more than 1 out of 4 chance that we won't have one. And certainly as the market continues to rally, there are many people, investors looking around, what recession? Why do these talking heads, why does this dude on Zoom keep saying we're going to have a recession? And a lot of people now believe that we're not going to have a recession. In fact, I'm hearing some pretty influential economists who are now reversing course saying, you know what? For a while, it looked like we were going to have a recession, but they now believe we won't. So what are some of these reasons that they're using to make a case against a recession in 2023? So let's talk about it. Number one, consumer cash levels are still very high. We've got a lot of households with very high levels of cash. And all of that cash was saved up during the pandemic. We were under, shelter in place orders. We couldn't go out anywhere. You couldn't travel, couldn't go to the movies, couldn't go out to eat very much. So people saved a lot of money. So that's one thing. They've got a lot of money and they're not really dipping into, they're not using debt basically to finance all these things. They are using cash. The other thing is that they have high levels of cash plus the effect of inflation, certainly last year in 2022, eroded their purchasing power. So a lot of people are like, well, I've got cash to spend, but man, I don't want to spend it right now. I'm going to have to pay double what I was paying before. Maybe I should wait for prices to stabilize a little bit. So inflation has eroded a lot of that purchasing power, and consumers have been spending more wisely. And consumer spending has stayed just strong enough to keep the economy moving forward. Consumer spending is what drives the economy. 70% of our nation's gross domestic product is driven by consumer spending. And of that, you can break that up into two pieces. One is goods, the other is services. Goods account for 1/3 of all consumer spending. Services account for 2/3. So when you listen to the news and you hear these dire predictions by Walmart and Target and Home Depot and Lowe's and these major retailers, and their earnings are going to be down, people get really concerned. Oh my God, if Walmart is suffering, then it must be cataclysmic. That's in goods. People aren't spending. It's not that people don't have money to spend. It's that they're spending them on other things. They're not going to buy goods as much. Where are they spending it? On services, going out to eat, traveling, going to the movies, going to sporting events, concerts. Also, rent. Rent is considered a service. It may be part of housing, but it's considered a service. You are buying the right, the service to live in someone else's home. And rents have shot up through the roof. That is why inflation has been so difficult to bring down, because most of that inflation is tied to services, the things that consumers will give up last. We will buy fewer items at the grocery store. Most people don't like giving up going out to eat and all the fun stuff, right? Even with all this inflation, the consumer has stayed very strong in spending. And right now, they're not spending exorbitant amounts of money, but they are spending enough consistently to keep the economy moving forward. So the consumer has been acting as a firewall between recession and not recession. And so far, that firewall is holding very firm. The American consumer has been historically resilient through all of this. And there have been two things at play. It's our hatred and fear of inflation, but we still have all that pent-up demand after the pandemic. One of those two forces will have to eventually give way. Personally, I still believe that consumer spending will slow. All that pent up demand will eventually get expressed. I mean, if you really think about it, the world's only been open for the last 18 months. Okay. So there's still a lot of that residual pent up spending after the pandemic. But this is one reason why the probability of a recession is that we won't have one, because consumer spending continues to be very strong. And at least for right now, doesn't look like that is wavering. Number two, and I've got 5 reasons why a recession may not happen. Businesses are hoarding labor. After the pandemic, or during the pandemic, a lot of people just chose, you know what, they got laid off, their business is shut down, and a lot of people just said, I'm not going back to work. I'm just not going to go back. And a lot of those people still haven't. The Great Resignation, we heard it called. So that created a labor shortage later on when the world did open up. And now we go out to eat and there's shortages of wait staff, there's shortages of bus drivers, there's shortages of pilots, shortages of cruise ship captains, shortages of people running the movie theaters. There's shortages everywhere. Help wanted, help wanted. You see it all over the place. Then you throw in the fact that many baby boomers who were either laid off or they took early retirement. We have many clients that work in the airline industry. Many of them were flight attendants, and a lot of them were offered early retirement by American Airlines, things like that, and they took it. So you got a lot of baby boomers that chose to retire or will retire over the next decade, and that's only going to add to the labor shortage. You got a lot of people leaving the workforce. There aren't enough Generation X and Y and Z and Millennial, whatever they all are, to make up the gap. You throw in the fact that attracting, hiring, training, and retaining talent is extremely time intensive and expensive. As a result, businesses, even if they're struggling, are desperately seeking to avoid laying people off. Why? Because it's really hard to find good people, especially when there's a labor shortage. Because of this, it favors workers. It supports higher than average wages. Wages go up, it's supply and demand. If the demand for labor is high, but the supply is low, then the laborers can command higher wages. When they have higher wages and more discretionary income to spend, what do? They go out and spend it, which drives consumer spending, which drives the economy forward. And because businesses are very loath to lay people off, that is what is continuing to prop up, or one thing that's continuing to prop up the economy and actually increases the probability that we won't have a recession. Consumers and businesses are carrying less debt right now. Since the 2008 financial crisis, which was driven by bad loans, bad debt, many households and businesses around the nation are borrowing much more responsibly. They're borrowing less, or when they do, they borrow smaller, or they don't borrow, or they borrow less. Did you know that the percent of household income spent on principal and interest payments is at the lowest it's been in our country's history? The percent, not the dollar amount, but the percent of debt to income. Businesses are spending record low levels of profits on debt servicing. So again, businesses have been hoarding cash. They have been avoiding borrowing money until all of this shakes out. And of course, right now, it's very expensive to borrow money. If you've got cash, you are king or queen. Not to mention that many existing loans were taken out before the interest rates went up. So even those loans that people have, the debt servicing, the payments on that are very small relative to what they would be with new loans. So in advance of a recession, we typically see periods of high debt levels. We're not really seeing that right now. Now that could change. And it also depends upon your socioeconomic group, your demographic group. All right. Right now, the households that are most likely to be carrying high levels of debt are those that have the lowest incomes, because they don't have income to support their lifestyle. So you're seeing lower income families have higher debt to income ratios. But A lot of the middle class and certainly upper class, their debt to income ratios have actually gone down. And that is opposite of what we typically see when a recession or prior to a recession. We've also got anchored expectations for inflation. One of the biggest fears that drives the probability of a recession is the threat that inflation will run out of control for an extended period of time. If inflation runs out of control for an extended period of time, the only or the primary tool that the Federal Reserve has to fight against it is raising interest rates. The entire reason, or one big reason that the market reacted so negatively last year is because everyone just knew that interest rates were going to keep going up and there was no end in sight. When inflation peaked at 9% in July of last year, people were losing their minds. They're like, how long is this going to go on? I mean, are we going to have to raise interest rates to double digits to get out of this? What is going to happen? There was so much uncertainty. However, now investors see, you know what? The Fed's doing its job. They said they were going to raise rates to curb inflation, and by golly, they've done it. It was 9%, it's at 4%. It's a big decrease, right? So they've done a great job of setting the expectation for the investor public that inflation is coming down, people see it, and therefore they believe what the Fed says when, well, we're going to continue raising rates and we're going to get, they've done a pretty good job of managing our expectations of where they want inflation and where they're going to have to raise rates to get there. As a result, consumers and businesses have hope. They have hope that there is an end in sight because they see results. And when we have hope, we tend to invest that way. The market is largely driven by hopes and dreams. It's driven by profits as well. But the way we invest is, what do we believe is going to happen and what do we hope is going to happen in the future? And that's what drives the market. That's why it's an emotional roller coaster. And right now, the American consumer has a lot of hope collectively that we're going to get out of this. And finally, the fifth thing, oil prices have moderated. Since World War II, there have been a dozen recessions, and prior to each one, there was a major spike in oil prices. Now, we did see oil spike in February of 2022 when Russia invaded Ukraine. There were all kinds of economic sanctions put against Russia, which did impact the supply of oil that we import to the United States. And we did see oil prices spike. We've also seen OPEC cut production a few times. But even with all that, oil prices now have moderated back to pre-Russian invasion levels. I don't know where it's sitting right now. It's around $70-something a barrel, I guess. But you know, it got up well over $100. Now, what was it, 120 at one point? I don't even remember. But we have better extraction methods for oil. We've got fracking and horizontal drilling. There's uncertainty right now about China. China has reported strong economic growth. They have reopened, but they could go back to a zero tolerance policy on COVID if there was another outbreak like that. And as a result, there's a lot of uncertainty on whether the demand in China for oil will go up again. If it does, then we would probably see oil prices spike again. But right now it's being moderated. And then we have made a move toward some green energy. All these things together have helped to drive down oil prices. And when energy prices are lower, we have more money in our pockets to spend, which drives the economy. And there you go. All right. So what does this all mean? I know it sounds like I'm talking out of both sides of my mouth here. It's not true. We still believe there will be a recession this year. We put the odds at 70%. There's still a lot of uncertainty. I've already shared with you the reasons why we believe, the reasons that would seem to indicate we are moving toward a recession. But that could change. That could change. So what should you be doing now? Well, I'll tell you what we've been doing for a lot of our clients. Not all of them. It's a case-by-case basis. But for many of our clients, particularly those who have a moderate appetite for risk, they're either close to retirement or in retirement, and they're taking income out of their portfolio or will be soon, we have been getting more defensive. We've been including some more defensive strategies in their portfolios. Not permanently necessarily, but temporarily to kind of get through this next phase. So some defensive strategies, well, there's a lot of different ways. You can shift from growth to income. Income producing assets are less risky than the assets whose value is seen in their price appreciation, right? So income producing assets, dividend stocks, things like that. Bonds are a really good thing to buy right now. You know, if you get into bonds now, you're going to be buying them at a discount, paying a much higher interest rate than this same time last year. And then if interest rates do go down in the next 12 months, you're still going to have that higher interest rate, but now you're going to see the value of your bonds come up, because when interest rates go up, bond values go down and vice versa. You know, you might want to consider looking at more defensive industries to buy stocks in. Things like healthcare, pharmaceuticals, financials have been very strong. Even with the bank closures and the bank failures that we saw earlier in the year, the financial industry is still pretty strong right now. Consumer staples are usually pretty strong. Industrials, materials, things like that. What you'd want to avoid doing is just going all to cash, okay? Because here's the thing. Number one, if you go all the cash inside of a taxable account, you could generate a bunch of capital gains taxes for yourself. So you got to be very careful about that. But the other thing you need to keep in mind is this. Yes, there will likely be more volatility as we go through summer and into the third quarter, and particularly if there is a recession. There will be a pullback in the market. How much? I don't know. It could give back everything it's earned so far this year. That's why getting defensive can help to alleviate some of that. But what you don't want to do is to miss out on when the rally begins again. There will be a rally. In fact, there will be another expansion. Every recession in US history has been followed by an economic expansion, and the market in the United States is 100% on regaining and blowing past a previous high point following a recession. It takes time, but the market has never failed to reacquire and blow past a previous high point following a dip. 100%. It will happen. So you don't want to miss out on that. And if you're completely unexposed to stocks, you'll miss out on a good portion of that. Recessions can be painful. Nobody wants to go through it. And like I said, I hope I'm wrong. It's not just me. It's ChappelWood. It's many of our investment strategists believe that a recession is coming. However, the market always recovers after. Defense is good. Panic is not. I'm going to show you one last thing. So take a look at this little graph. I know there's a lot going on here, but this is showing you recessions from 1953 all the way to the pandemic, the coronavirus, the COVID recession that began in February of 2020. Look at the relative performance of the stock market during the recession, all right? If you take a look there, the average return is minus 1% during the recession. However, look down at the very bottom, the percent of positive return periods. 45, even during a recession, over these many recessions here, including the last one that we had, 45% of the time, the market's return during the recession is positive. That's almost 50%. That's pretty damn good, considering. In the 6 months prior to the recession, that's when you typically see the market perform the worst, right? It's that prelude to the recession. That's pretty typical. The market begins to slide down as the economy begins to cool off. Even so, 45% of the time in the 6 months leading up to the recession, the market has had positive returns. 1 year before the recession, same thing. But then look what happens 6 months after the recession. Let me move my, I got to move my little toolbar around here. There we go. 6 months after the recession is over, or actually after it has begun, look at the return for the market, 7%. That's the average. And the percentage of returns, 82% of the time, the market is positive just 6 months after the beginning of the recession. So if the recession begins in the end of the third quarter of this year, September, the market dips. Based on this, by March of the following year, just 6 months, the average return on the market is 7%. And there's an 82% probability that it would be positive in some way, shape, or form. 1 year following the recession, the average return on the market is 16%, and the market is positive 91% of the time. Just 1 year following a recession. 2 years, the average return of the market is 20%. And 82% of the time, the market is up. The point I'm trying to make is this. It's good to play defense and try to minimize any of the damage to your portfolio. But it is totally wrong and short-sighted to believe that this recession, if there is one, is going to be any worse than any one of these. You see what history, we've got a lot of history to indicate that the market does rebound and rebounds big, and you don't want to miss that. You don't want to miss out on that. All right. It's just shortly after 1 o'clock. And so I want to thank you so much for joining us today. If you've got any other questions here, I'd be happy to entertain those. Or if you want to just send me a message, you can, and I'd be happy to answer your question offline. You can email me at damon@chappelwood.com. You can also text your question to us. Our number is 405-348-0909. Text your question, and I'd be happy to respond to that as well. So, so far, so good. Like I said, I hope I'm wrong. I hope that there is no recession. I know you do too. And we'll continue to track it. We'll continue to stay on top of it. And if you have any questions, certainly if you're one of our clients and you have any questions, you know where to find us. And if you're not yet a member of the ChappelWood family and you just want to bounce an idea off of us, well, we're here for that too. Thanks so much. We'll see you next time on the Wednesday lunchtime drive-thru. Bye-bye.